Any numbers that you have on profitability or the money that is made? It's easy to understand from brands perspective because they
Correct.
get royalty,
Correct.
right? And so there's the brand that is being built.
Correct.
But for the franchisees, how much money do they actually make?
So actually, if you take pizza as a segment, it's a highly profitable segment. Gross margins are at 77 or 76% for both Jubilant and Pizza Hut. And the burger category has a lower margin of around 66 to 67%. So if you compare this with other FMCG players, like I guess HUL and Nestle have a gross margins of 70 and 65%. So these are very respectable gross margins. And coming to their EBITDA margins, they make around 26 to 23%. Sapphire, which is the second franchisee of Yum Brands, is still has to make a profit, but they're growing rapidly. And as an investor, what I think we should more focus on is at the rate at which these companies are growing. So when we look at their growth, we typically break it down into two segments. One is the same store sales growth, or the SSG, which means that if they had 100 stores last year, how well did these stores do in the current year? And the second part of the growth is the growth which is because of new stores which has been added. So, usually SSG, that part of the growth is highly profitable, because when your same store makes incremental sales just because of operating leverage, it's very profitable for the company.
Brilliant. Thanks for breaking it down. It kind of gives me a very quick overview of the whole sector and how it operates. If I had to dig in, I would probably take 2, 3, maybe 5 days, maybe a couple of weeks to go through the company statements, Google it, the annual reports. So that was a very quick fire overview.
So just one thing which I wanted to add is that there's this thing called negative working capital. So, or you can also look at it from a cash conversion point of view. So these franchises work on a negative working capital principle. This is because they don't sell anything on credit, unlike all the other businesses. Like 90% in businesses in India have to sell on credit, but these businesses sell on cash. And their inventory days are also very low, because basically they're working in perishable items. And their payable days are very high, because these guys have pricing power. They pay their vendors on an average in 160 to 170 days. So net their net working capital is around 150 days. And because of this, they tend to be cash rich. And once they open a store, it acts as a cash generating machine, which helps them to fund their next store. So this is, I guess, a sign of a good business. Most of the popular FMCG businesses also have the same concept, and this is a strong sign of pricing power.
Yeah, it's such a fascinating fact. As a person who's worked with over 150, 200 startups across India and the US, one of the biggest killers of startups or any new businesses in the first 5 years is cash flow.
Correct.
And that's why they call it cash is king. And so if this sector, QSR sector, is so cash rich, you can just put so much of that money into
Correct.
growth, and that's not even at the cost of debt or
Correct.
anything else. So lovely to hear that.